the ECB is in a different position than the Fed. The Fed has hiked, and the ECB is looking at a different economic scenario. Why is that actually? Because inflation rates are almost at par.
Well, indeed, the ECB is in a very difficult place. I mean, for once, right now already the war is in Europe, right? And it has much stronger effects, of course, on Europe, energy prices in Europe than in the US, because, for example, gas is not the same price natural gas is not the same price in Europe as in the US. On top of that, I think the ECB is even more behind the curve than the Fed. Well, the Fed had a stronger inflation shock coming into this, and the ECB felt probably they could wait and this will be temporary, but now they have to change course. They've signaled that already. I thought it was good that they kept open the option of earlier interest rate hikes, but it's going to be tough.
Yeah, if you look at the market, this five-year forward, it's also above target. So do you think that was one of the main reasons why the ECB kind of surprisingly actually announced last week that they are ending the APP?
Well, I think when you come to the five-year forward, it seems like a long-term inflation forecast, but in fact, if you look historically, it moves with energy prices. So it just signals that the inflation shock is even bigger. I think the ECB already before the war started in January, in February, was surprised by the inflation data. And so it was realizing more and more that they have to do more. Now, with the risk we have now of even higher inflation and maybe similar inflation as in the US, real interest rates are falling, right? So we had a dramatic decline in real interest rates. So anything the ECB does in terms of nominal interest rates is really small compared to the automatic, easier policy or the easier interest rate conditions, financial conditions you get from higher inflation. So they do have to move pretty soon, but I was at least encouraged. They seem to be aware of that.
Let's talk a bit about the wage aspects, because they always say that as long as they don't see wage increases, like second-round effects, they are not overly concerned that we're going to see persistent and higher inflation. What's your assessment?
Well, if you look at the relative purchasing power losses people face, they are huge, right? We already had the 3% average, or December to December 5% last year. Now we're going to get a good bit more this year. These are peak losses in terms of purchasing power. So it would be foolish to assume that people don't want this to recoup. The only situation where they cannot recoup that and get something on top is when you have high unemployment. But we're not there yet, and I think we are much more likely to continue to be faced with labor shortages in different areas. So I think wage inflation is a lagging indicator. It's a lagging effect. It'll come. It comes more slowly in Europe than in the US. US, it's already been happening. In Europe, it's more driven by wage negotiations, which are more longer lasting, and other price rigidities. But it's basically in the pipeline. If you talk to union organizers, to union negotiators, you know that they are aware that they need to ask something for their clientele.
What do you think will the normalization path of the ECB look like, especially against that potential uncertainty of an economic shock here in the Eurozone?
Well, the problem is also the risks go in two directions, right? Higher inflation and lower growth, which makes it particularly difficult. It's interesting, a number of speakers from the ECB have talked about a neutral rate of 1.5%, which is pretty low. So from that perspective, it still may look like, okay, it's not going to take us that long to get to a neutral level, you know, maybe normalizing from negative rates going to positive this year, and then over the next 2 years get to the neutral level. But there is always the risk that this neutral level is underestimated.
Do you think with the Fed now being clearly on the hiking cycle, that the ECB can isolate from what actually the world's biggest central bank is doing, especially looking at what it means for yields on the bond markets?
Yeah. No, I don't think they can isolate from that. I guess the impression was, well, both the long run, right, if you think of the Fed's assessment of the neutral rate, it's closer to 2.5%, and also the speed in which inflation rose there and the second round effects happened. The idea was that the ECB could move more slowly, but the risk is, with the war being much closer to us than the US, that changes.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.